Welcome to the daily update, where I'll go over the action in the market for Friday, May 31st, and then we'll see how things look for Monday, June 3rd. One of the more interesting days than what we've seen in a while. We were looking pretty negative. The weakness that we saw coming into the market was starting to compound. Well, at least with the S&P, we came down to the 5,200 level, which was just a little bit above the 50-day moving average. And we bounced off of that fairly quickly. I was watching this as it was unfolding, and we just saw a real reversal as the day went on. Now, we still have some weakness that's coming into the market, but with the nice up move that we saw on Friday, we could be seeing signs of an improvement taking place. We'll just have to see what kind of follow through we get. So we're still kind of in between right now. We were turning decidedly more negative. We had lost the short-term time frame over to being negative. We came down, tested the 50-day, more intermediate term, and so far that has held up. We did get a very important inflation report in Friday's session that initially the market kind of took as negative, but then as the day went on, everything kind of switched back over and turned more positive. Now, this next section that I'm going to talk about, I'll put some chapters in the YouTube video. I can't do that for Rumble. This is going to be the last public video, last daily video that I post, because this week I'm starting my program, and either members who belong to the program or people that pay $19 a month will have earlier access to the daily videos. That's the real foundation of the analysis that I do. But some of you have already watched this, some of you aren't interested. So once I get this video recorded, I'll put a chapter mark right at the end of this part and then go into the evaluation of where we're at right now. If you want to at least check things out, it's kind of clunky. I'm calling it an open house right now, and it's like a house that's almost finished being built, but there's no furniture in there yet. So there's not a lot of things going on. I'm rolling everything out on Substack. And while I do that, I'm going to keep everything free for at least the month of June. Okay. I don't know if that's going to be extended out. There's some new ideas that I'm trying, things that are a little bit different. I'll need lots of feedback from people. And I will be starting Monday giving you a link where you can go and actually see that on Substack. It's kind of hidden right now. I want to get some things in order before I actually turn it loose on people. But if you do decide that you want to be a member in the program, that will be $97 a month. But for June, at least, I still need you to sign up to get to parts of the website. So that will cost you an email address. And if you decide that you don't want to be a member later on, just unsubscribe and I won't bother you anymore. But if you want to be informed about what's going on, that email address is a way that I'm able to communicate with you. There's also a thing called the affiliate program, and everybody who is a member is automatically an affiliate, but you don't have to take advantage of this. I know that $97 a month is really not all that much when it comes to what I'm offering, but it's still a lot to other people. And so I want to make a way available so that you can still be in the program without having it cost as much. And the affiliate program is, if you get one other person involved, and for as long as they're a member in good standing, month after month after month, half of that $97 will be credited to you. If you get two people, now that full $97 will be credited to you for every month that that person that you got into the program remains in good standing. So you have to be careful about this. You want to pick good quality people who aren't just doing this to do something quick and then fade away. Because if the two people that you have, or even the one person, if they flake out and decide this isn't really for them, or they just don't like the program, or they're just not able to do it, then you're going to lose that part of your membership being covered. So just something to be aware of. Also, just to go through some of the things that I will be including, naturally, you'll have first access to the daily videos. What I'm doing is I upload the video to YouTube, but then I set it to go public right at 4 p.m. Eastern. That's right when the market closes, because there's still a significant number of people who watch the videos after the market closes, even though it's intended to be watched before the market opens, or maybe earlier in the day, because based on the program that I do, we do everything as late in the day as possible. I do have a whole series of online courses. It's well over 100 hours. I'm recording it now, so I can't come up with an actual number. But there's a basic course that's on YouTube and Rumble. That's a few years old. I'm re-recording it and updating things a little bit. I'm also recording things in a little different way, because the course that's on there now, it took me twice as long to edit it as it did to prepare and record it. And so I'm going more freestyle now. This is more improv type of a thing, because I can record these videos pretty quick. Yeah, you get my fumbled words, you get mistakes that I make and so forth, but I can do these a lot quicker. My intent is, with all of these courses, is to update them on a regular basis. I make little changes. Charts will be different. New things may come in. I may take old things out. So I'm constantly updating those things. And when I think about having to record that and spend all that time editing, it shuts me down. And so doing it more like a live concert instead of a studio production, it may not be as polished, but it's going to be, I feel, a much more productive way of doing things. But I do have the basic course, and that's designed for folks that really are new to the markets. It could also be a good overview of things if you've been involved for a while. And then I'll be rolling out the technical analysis course. I place a huge emphasis on technical analysis. It's what determines what strategies I implement, whether we're going up or down or sideways. And that's different than what a lot of people do. They're just playing probabilities, they're playing statistics, which fits into what I do as well. But if you combine that with a real detailed look at what is actually happening in the market, it gives you a lot more robust program. And then I'll also be rolling out some strategies. Now, there are more complicated strategies that will be added later, but there's a foundation of strategies that I use on a day in and day out basis. Those are the ones that I'm going to be talking about first. Some of these are going to be things that you might already be doing now. Others are a little bit challenging and maybe something you haven't done before. The idea is to learn about these and practice them before you put real money on the line with that. And then the last course will be about mental analysis. And to me, this is the most important one, because you can learn all of what you need to know, but if you're freaking out emotionally, it's like all the knowledge that you have just flies right out the window. There will be, at points, live online courses where we do this over the internet, probably through Zoom or Skype or something like that. And as a member, you'll have the ability to attend the course as it's being presented, and then there'll be a recording of that. This won't be a public video. This will just be for members. And I also want lots of feedback. Those of you that are going through these courses, let me know different areas that maybe I should spend more time on, because I'm not going to go through all 4 courses. It's over 100 hours. We'd all just be sitting here just zombies forever. This would be more tailored to a shorter time frame. And I would also be willing to do that live in different locations if I can get enough people to justify me going to a specific place. That's certainly possible, but it's not the real foundation of what I'm doing. It just might be something nice that would happen down the road. Then there is a community chat room, and I've set that up. I've tried to test it out a little bit. I'm going with the idea right now that it's not going to be moderated, because I'm assuming, of course, you know what happens when you assume things, but I feel I have the best program out there. And so that brings in the best students. And I feel that we're mature adults. We can communicate with each other and still remain respectful and maintain respect for each other during that time. Because if you're not that way, you won't even get a second chance. You'll just be booted right out and just gone. But if it comes down to the point where things have to be moderated, I will do that. But I'm hoping anyway, that doesn't even need to happen. And then there'll be areas where I'll do some online posting. And I have a couple of different ideas with how this is going to go. I'm just thinking of running like a blog where I just post things. Maybe that particular page lasts for the whole month. And then the next month we jump over and start posting for the next month as well. And bear with me on that as we work out. And I say we, I mean me, but with your feedback, work out just different ideas and ways that is the most effective for doing this. It'll be a chance for you to ask questions and possibly find answers about different things. It's supposed to be a safe environment where you can come in. Maybe you camp there. I'll be camped there all the time. But I may not actually be involved in the room. I may be doing something different. But it would be nice if you see an article or something happens and you don't know really what's going on, or you do know what's going on and you want to tell folks. That type of a thing where we can just maintain constant communication with each other. And then we want to try to keep that rather limited. No really long posts about your philosophy on life, no manifestos or anything like that. I've said this before. If you want to do something like that and you don't know how to do it, contact me. I'll tell you how to set up a blog. You can do it for free. And I want to keep it relevant to the program. Yeah, there may be a little off-topic things that happen from time to time, but we want to come back to focus. We don't want to drift off into areas that are already dividing our culture as much as it is. We've got the stock market to try to figure out, and all that other stuff can just stay for another place, as far as I'm concerned. And then I will be doing video debriefs and well as reviews where just for members, maybe we'll get together once a week and just say, how was your week? How did things go? Did you have a good week, a bad week? Did you do something that you want to tell us about? Did you make some mistakes? And we have some input and we can go back and talk about that. Now, one thing I have not been mentioning in these videos is there is also the opportunity for you to have one-on-one contact with me, either through Zoom or Skype or Messenger, or I don't use FaceTime now, but I could. Some type of a method, and it can be audio only, it can be video. We can just stick to it by email or messaging, whatever works best for you. A lot of people, they like to have interaction where you can see me, I can see them. That's fine. Personally, if I was a member of the program, I wouldn't want to do that. It's like, just leave me alone. I can make my own decisions. But since I'm the instructor of this whole thing, I have to go into teacher mode rather than participant mode. And I want to make that available to folks that want to take advantage of that. But as things grow, my time is probably going to become more and more limited. So, but for right now, there's really no limit. We talk as long as we need to talk. And if it is solved in a few minutes, great. If not, great. Because I also got into this not only to help people, but I'm meeting some of the most fantastic people by doing what I'm doing now. And there's a lot of other fantastic people yet out there that I haven't even met yet. And I'm looking forward to that. All right. And then there will be some live sessions. If we're looking at implementing part of a plan, usually what will happen is I like to keep this as late as possible, but usually about 15 to 30 minutes left in the trading day, because we do everything as close as we can to the close. That's for entering a position. I focus a lot on getting in, because if you get in right, getting out almost takes care of itself. You're going to either hit your profit target or your time target or some level that you already predetermined before you even got in. And so that's just going to happen, and that can happen at any time. But getting into a position, that takes a little bit more finesse. And so I may have a room, or I may open up a Zoom room or a Skype room or something, and you can just join if you want to, and it'll be recorded so you can go back and watch it later. But it's just where we're looking at things, talking to each other. Some people may decide to do nothing. Other people may decide to get into a position. Other people may have a position that they decide to even expand on. And that's usually what I do, is I layer my way in. And then usually I'll get out about at the same time with everything, because something's changed to the point where that position is no longer what I want to have. But sometimes I'll actually layer my way out as well, and then let yourself get taken out of the market using things like trailing stops and so forth. Anyway, these will be available to you. And like I have said before, I may set up one of these live sessions, and if nobody comes up, I'll just talk to myself. This is what I'm doing right now as I'm recording this. I'm a teacher. I'm used to talking to a room of people that aren't really listening. So, all right. And then there'll be different, what I'm calling vlog posts. These will just be additional to the daily videos that I do now, where I might do a video before the market opens. Now, I teach English to Chinese children, and I'm in Eastern Europe. And so my time is much different than US time right now. And sometimes I'm getting done with teaching right about the time the market is opening because of the whole time factor. I want to be able to do this. I'm planning on doing this, but I don't know how committed I can be to that at this particular time. And then as the day goes on, I may do updates. They may be text updates. They may be video updates. And then, as I said and talked about earlier, I may go live when we're possibly entering a new position, because to me, that's the most important part. And then there are supplemental videos. I just got done reading a book. It's called The History of the United States in 5 Crashes. And it goes back to 1907, 1929, 1987, the great financial crisis, and then just talks about what was going on at that time. And being a history teacher as well, I found I like the history part, and then the stock market part is interesting. Well, maybe I want to do a video about that. I'm starting another book right now that's more about the history of the stock market. It applies to what we're doing, but it's supplemental because it's just additional information that some of you may find interesting, and others may go, well, I'm not really into this. Just tell me how I can buy low and sell high. That's really all I care about. And then there will be a sample portfolio plan and ideas. What we do is we evaluate on a technical basis, what's the market doing right now? That's why I put so much emphasis in these daily videos. Based on that, we say, okay, we want to get in a long position or a short position if we're going up or down. And then we fill out a whole sheet using things from this video. We have different areas of, let's say we're going long. We have areas of overhead resistance that we need to keep an eye on. You might have a predetermined, in fact, you should have a predetermined loss that you're willing to assume before you say, okay, I was just wrong about this one. And you have a predetermined profit target. It may be based on a percentage basis when we hit a certain level. If you're doing other kinds of strategies, it may be based on a time factor. You're working with the calendar, and sometimes that can really play into it. And I'll have what I call a daily journal, and that's kind of combined with an action sheet. It'll be made available as a PDF, and that'll be blank, and that's one that you can fill out every day. You can fill out on the computer, or there'll be a blank one that you can print out and maybe have your own little notebook of things. Because this is a really good way to learn. And this is something I've done for decades. I started this at the very beginning. And it's really interesting a few weeks into the future to come back and say, okay, what was happening at that time? What were the decisions that I was making? What things ended up being right? What was wrong? And it just, you're able to just keep track of not only what's happening in the market, but how you're growing in the whole program as well. And then if you want to talk about this, it'll be spxinvesting@gmail.com. That's more of my public email address. Now, after I get the membership thing up and going, I have more of a private email address that will be available to members to actually send things to me back and forth. I just want to keep the two a little bit separate. Okay, I am done with this part. This is where I'll put in the chapter marker so that from this point forward, now I'm going to go back and talk about what happened during the day. This is a little lengthier right now because this is my last public video where I'll be able to explain the program. It's also over a weekend. I tend to have more people watching the weekend videos who maybe don't know anything about this. But if you're just not interested, okay, now is where the chapter section is going to go. So right at the open, we did have a higher open. There was initial positive reaction to the core PCE and all, the whole report that came out, and we got up to R1 at 52.56, but then things started to turn. We fell below the daily pivot at 52.39, and then we fell below the unchanged level. We didn't just fill the gap, we kept going. And it's like, oh boy, here we go. Prices declined all the way down below S1, which I don't have marked on here, and slightly below S2, and we got down just about to the 5,200 level. Now, this wasn't exact, and we had a lot of different indexes that were hitting support at the same time, but we did bounce from around that 5,200 level, which also ended up being the 50 close to the 50-day moving average on the daily chart. Prices then reversed. We regained S2. We got back above S1, the unchanged level, the daily pivot. And then we just broke positive and went up above R1, which we visited right after the open, and then closed at R2 at 52.77. So it turned out to be a pretty decisive bounce. Now we're going to see what kind of follow through, if any, are we going to get from this. So we were up 0.8% and we were down about 0.75% or so. And the NASDAQ and NASDAQ 100, my goodness, they were down 1.5% to 2% at some point, just looking terrible. It looked like, baby, we're just going down and we're going down something fierce. But we hit support and to this point have bounced. And we, for the first time in quite a while, we were way above average with volume. So there's a lot of movement that went on in Friday's session. We're still trying to decide, is this just a one-day wonder type of thing? Because we've switched back now to positive in the short term, where we had gone negative. We were just a little bit below the 20-period moving averages. Those were recaptured. We bounced off the 50, so that's helping our intermediate term to turn a little more positive. But we're still seeing weakness in our charts. It's going to take more follow through than what we've seen, at least to this point. And then in Friday's session, yes, it was about inflation and interest rates. The core PCE came out. That was taken as friendly. And another thing that supported stocks on Friday was interest rates were coming down. And I was watching this. I'm like watching the market just go down, 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 down. And I'm looking at interest rates and they're down. And the VIX is kind of all over the place. And I'm like, okay, things haven't been settled yet. That's why we focus on the close. That's where things get settled, is going into the close. And then we want to keep an eye on all the different events that are happening. I'm not going to get into any detail here, but the recent verdict in the court case, that won't really have any impact on the stock market. So as far as I'm concerned and the program, there's really no need to even talk about that. And you know what I'm talking about. So some comments. S2 to R2 broad-based reversal. That is a pretty big swing and more action than we've seen in quite a while. S2 to the downside, we closed up at R2. And we not only saw this with the mega caps, we saw this across the market. And this was the last day of the week in the month. Somebody even on Twitter made a mistake like I usually make and say, oh, this was the end of the quarter. Did I just say that? It was the end of the week. So it was the last day of the week and the month, but it was not the end of the quarter. We still have another month to go until that happens. But see, I make mistakes like that all the time. And then I say them instead of type them. And all right. But we did, actually, this should be changed. We actually regained the 20-period moving averages here. I don't want to go back and restart this video. We found support just below S2, right around, just a little bit above the 5,200 level. We dropped a little bit under that. We didn't quite hit the 50-day moving, the 50-day moving average, but we were able to bounce up from that area. We're still looking extreme positive with the stochastics. It's our longer term charts takes a little bit longer to move. We have nothing oversold right now. We had a few, but we saw enough of a bounce, so there's really nothing being listed. I finally took out the quantitative tapering easing that helped us come out of the lows in April, but the scenario itself seems to be about the same, where they're leaving rates higher for longer because inflation hasn't slowed the way the Fed really wants it. They want it to get down to that 2% level. And we're possibly looking at September for the first rate cut. Now, I'll be going over the Fed watch charts in the weekly video, and we'll be able to dissect that and see what they're really looking at now. The dollar was down and interest rates were down. This did give some support to stocks. We were at 4.51% with the 10-year yield, where after Thursday, we were at 4.55%. We're still inverted with the yield curves, and sentiment is neutral. We ticked up to 48, where we had been at 43. So that showed a slight improvement. We're still not trending. The ADX is not quite sure what to do. So we're below the moving average and we're below 20 with our ADX, the average directional movement. And I should have changed. Okay, I'm not going to go back and start this video. The bias should actually be positive here. And the momentum, I would change over to mixed right now. So I'm doing this video in a very different time frame than I usually do because I have so much to do this weekend. So there's some areas here that I obviously missed. We did get personal income that came in as expected, being up 0.3%, down from the 0.5% we saw last time. And personal spending was down to 0.2%, where they expected 0.3%, and also down from the 0.7% that we saw last time. Then PCE prices came in as expected, being up 0.3%, which is what we saw last time. This was the big one. The core PCE came in up 0.2%, where they had expected it to be up 0.3%. Last time it was up 0.3%. At first, it seemed like the market didn't care. But then once we hit that support and bounced up, it's like, okay, we kind of like what's happening here. The Chicago PMI came in at 35.4. They expected it to come in at 41. Last time it was at 37.9. And these are not necessarily really strong numbers for the Chicago area. So here's some charts. Here's personal income and spending, where we have income. That's the yellow area, and it's not really growing all that much. And spending is actually declining on a year-over-year basis. We look at the core year-over-year inflation, where it's continuing to decline. The Fed wants to get down to this 2% level. We still have a ways to go to get there, but at least on a year-over-year basis, we're moving more in the right direction. Here's the month-over-month spending, where it trailed off from what we saw last time. And here's the Chicago PMI, which has been declining. If you go back to last November, when we had a fairly strong reading above 50, now we're continuing to drop off, just showing a bit of a disconnect between the stock market economy and real life economy. Here's the Isabel Net blog charts. Inflation is a monetary phenomenon. So we're following the red line here, which is the CPI. And then this black line is M2. We used to have a thing called M3, which until the gold ETF came out, and when gold was back about $400 an ounce, suddenly they just decided maybe we're not going to have M3 anymore. And it's like now we have to try to figure out, because that's the whole money supply right there. And that happened in about, I think, 2005, 2004, 2005, something like that. But we see sometimes they disconnect from each other. But lately, as the CPI has been going up, we're also seeing the money supply going up. And that's all the stimulus and the money that the Fed added to the U.S. economy to try to keep it from falling completely apart. Well, that's starting to come back down here as far as CPI. And we're seeing the M2 starting to go back up as well, which could end up adding some more liquidity to the market, which could also end up being inflationary. And then the median inflation 5 years before and after inflation first moves above 8%. I mean, it's like, my gosh, it's like you're reading a government document here. 50, okay, just look at this. This is here's the median. And then this is when things change right at the 0 point, and then what happens after that. And we tend to see more of a decline here with the median. That's the dark blue line. And then the current US cycle, which is in that red, and then the Eurozone. So we are tending to see inflation dropping off. Then looking at the earnings per share estimates, this is not only applying to what we're dealing with now, we're also forecasting out into the future. And these are going to change all the time. They are showing growth, even looking forward, which ultimately that's what determines stock prices, is how much a company can earn. And then what is the probability of a recession? It is dropping off a little bit. It's still kind of high. We're right around that 50% level. And then higher for longer rates are just off a 5,000 year low. And of course, all of you remember what it was like back in 3000 BC, what interest rates were then. But this is just showing over a very, very long course of all of human history what interest rates are compared to what they've been historically. And this is part of the shift that we're seeing. We didn't see that for 40 years in the US economy, as we were seeing interest rates really coming down. Now we're possibly going back up to a more higher interest rate environment. And then Bloomberg Financial Conditions Index, and this is really hard to read. This is like how I paint. You just kind of throw some paint on a canvas here. But we have a blue line, which you can barely see, which is the US, and that's just showing that things are loosening. I guess G3, that would be US, what is that, EZ, Eurozone, and then the UK. Why don't they have Japan in here? That's kind of discriminatory. But anyway, it's going up a little bit, even though it has been dropping back. When there's more loose financial conditions, that just means money's flowing more free, and a lot of that goes into the markets. I did find a couple interesting charts here. Chris Schiavocco puts out a video every week. I try to watch it. It's more longer term oriented than I am, but it can give you a good perspective. I recommend his channel on my YouTube channel. I have never even met the guy. He has no idea I even exist, but I try to watch his videos and they can be helpful. Well, he posted something on Twitter because this came out during the trading session, Market Watch, which was, well, I subscribe to them, and it's a little, they're considered to be a little bit better than some of the other crazy sites out there. But the headline was, why stock market gains seen after April's PCE inflation report faded so fast. This is when we were tanking down in the earlier part of the day. And he says this intraday headline did not age well because we bounced and ended up being up on the day. And then this is something, please be aware of this. The perma bears are just salivating because we've had the initial signal from a Hindenburg omen, but we haven't had the confirmation signal yet. But there may be folks that mislead and say, we have a Hindenburg omen. And I have a chart to show you later on, but it needs a confirmation signal before it's a real signal. And we have not had that, at least yet. But here, if you don't know much about that, market crash indicator with spotty track record. Okay, yeah, when you only use one signal, it has a really terrible track record. And that's one reason why I didn't use it, because it was presented to me as there was only one signal. I did a little bit more research and found out, no, there's a confirmation signal. And those signals are pretty good. But they say it triggered last week, and we've been watching this already. But people that don't really study the markets, they're going to read this and go, oh, yeah, Hindenburg omen, Hindenburg, all the humanity, the blow up, all that stuff. Well, I'm going to go in and sell. And they're going to make their decision based on this headline, but it's misleading. So that's why we need to, not only read the headlines, but look at what they're actually saying and then compare it with other information to say, is what we're being told actually true? Because we live in an age where all the different media, you don't know if you're being told the truth anymore. So you have to become your own research analyst to try to decide, okay, what is truth, what is not truth, what is relevant, what is not relevant. And that's part of my program, is we can be in that chat room talking about things and saying, well, yeah, it's interesting, but it really doesn't apply to what we're talking about. Or, okay, this is just kind of an outlier type of article. I'm not really seeing that confirmed anywhere else. This is just some theory that somebody came up with. We'll remember that, but we're not going to base our decisions around that. Or, okay, we're seeing a lot of confirmation, so I think this is looking more legitimate now. That's what the idea behind this chat room that I have is. All right, here's our intraday chart where we did gap higher. We made it all the way up to R1. Looked like, okay, maybe that's the high for the day. That's been the typical pattern lately. And then we started to come down. We filled the gap, but then we ended up going negative with some real fierce action. We broke down below S1. We actually broke a little bit below S2, came down just about to 5,200. And notice we didn't stay here very long. When we hit a resistance or a support level and sit there, the longer it sits there, the more dangerous it becomes, but it doesn't necessarily mean a rejection. I was referring to this a few weeks ago we were looking at an upper moving average, and it seemed like we would come up, come down, come up, come down. It finally ended up breaking above that, but it took a little bit of time. But when we see this like a ricochet almost coming down, hitting the low, and then bouncing up out of that, that means there's some more real conviction going on here. And we came back up to S1, stalled out for a little while, but then came back up, actually went positive, and then the last 20 minutes of the trading day, we just shot higher, and we ended up closing at R2, which was the high for the day. There's our intraday chart. There was a lot of apprehension ahead of the core PCE coming out, so the futures didn't really move all that much. Most of the action we saw was during the day, which is different than what we've been seeing lately. It seems like we either gap up or gap down and then don't really do anything as the day's open. Well, it was just the opposite of that in Friday's session. And this is looking okay now. We still have the blue line above the red line. That means growth is outperforming value on an intraday basis. We want to see the blue line going up. Now, we can still go higher if the red line is on top, as it did as we were coming up out of the April lows. It just seems to be stronger when we see the blue line above the red line. And this didn't really show much of an improvement. The growth to value ratio for the S&P, we declined. And once we hit the lows, we kind of blipped back up a little bit. So we didn't really see much of an improvement here. That's a little bit of a concern. End of day, growth was up, but look how much growth was up compared to value, because value had really gotten hit earlier on in the week, and growth was up less with the mid caps and also up about half as much with the small caps. So it was a more value day than what we saw in that bounce on Friday. So with our small cap growth to value ratio, we're declining. We're also declining with mid-cap growth to value, so not an improvement here. And we're declining with S&P growth to value. So this didn't really give us a lot of positive confirmation, but we still have to ultimately follow what price is doing. We're coming back down a little bit with this other growth to value ratio. This had actually been holding up better. Well, it ended up coming down, but it's still above the rainbow. And discretionary just kind of ticked a little bit. We didn't see much of an improvement there. And if you compare the second chart down with discretionary, we're coming right back up to its 50-day moving average. We saw more of an upward move with staples. And so that's why we saw this ratio coming down slightly. Large cap growth, this could be interesting. We came down to the low for the day and then closed pretty much at the high. We're still above the 50-period moving average with large cap growth. The Wilshire came down to its 50-day moving average and bounced up off of that. So far that 50-day moving average, we're seeing it confirmed across multiple indexes. But our trend, though, as the ADX is trying to figure out what's going on here, it's still crossed over with the red line above the green line. So we are still negative that way. We're not trending because the ADX is below its moving average and it's below 20. If we're going to see more follow through, we want to see the green line go back above the red line, and we want to see the ADX turn up, go above 20, and stay above its moving average. And short term, also dropping below 20, still looking more negative. We did really pick up with volume. It seemed astronomical compared to what we have been seeing lately. We are still coming up a bit with the Ulcer Index, but we're still below the moving average. This is the latest rating that we had a few days ago, the bear bull ratio put out by Investors Intelligence. We came in at 3.45. We're above the 3 level. And we actually declined here with the VIX. It was going up pretty good there for a while, but then as we were going up with price, we saw the VIX really come down with the line chart, and we closed at the bottom here with the bar chart. And the volatility of the VIX, it was dancing around, not as much as you might think, but this is a pretty wide bar compared to the last few days. But we ended up closing right at the low because of the up day with the VIX of the VIX. And we're still going up, though, with the momentum of the VIX as measured by the MACD. And we're coming down out of the red area. So the market had been expecting some kind of a big move. After Thursday, it looked like maybe it would be to the downside. Even the first half of Friday, it looked like it was going to be to the downside. And then we reversed. That's why we can't really use this chart to make decisions. It just tells us something is getting ready to happen usually. But now we've dropped down out of that red area. I haven't updated this because I had to record this video. I didn't have to. I chose to record this video earlier than usual. These are the last charts to update from the CBOE. So we can just assume that we're still going up. And we came down a little bit here with the volatility risk premium. We're coming back down into this band after getting up to kind of a high reading, which shot up after giving us a very low reading. We came down with this fear gauge. We also ticked down with this other fear gauge. And then this is a combination of the AAII, that's the American Association of Individual Investors, and then the sentiment that we look at, and it tries to put them together. And it's not really giving us an extreme reading at the current time. Advanced decline line, we saw a bit of an improvement even on a down day after Thursday. Well, it's continuing to show some improvement after Friday. We came up based on price, and we're actually looking a little stronger when we measure this based on volume. And you can see the green bar for volume is a lot higher than what we're seeing for price. That's showing some potential internal strength. We did see an expansion of the new highs and a contraction of the new lows, pretty much the same as what we saw on Thursday. On a momentum basis, we're still declining with the 5 and the 10, but this is looking a little bit better. If we can sustain more of a bounce, we would expect these new highs to continue to go up. We are looking more positive with our advanced decline ratio, both in the short term, that's the blue line, and the red line, which is the more intermediate term. This is something that we were hanging on to as something positive. This is a smart money indicator, and we went up in Friday's session, and we're above the moving average, and the moving average is sloping up as well. This is something that I also picked out after Thursday. Even with the down day, the Chaikin money flow ticked up. You can see the bar for Thursday, and the moving average is going up. Well, that's still continuing. So this could be taken as positive. Chaikin oscillator never did go negative and did bounce on Friday. And we saw a nice little bounce up here with the cumulative NYSE advanced decline line, also an improvement with the regular NYSE advanced decline line, also showing some improvement with this other NYSE advanced decline line. Looking at common stock based on price, we saw an improvement, and volume, actually seeing a little bit more of an improvement based on volume. I have been showing this lately. This is the NYSE new highs minus the new lows. We had dropped negative. Well, with the up day, the up close, I should say, on Friday, we turned back positive with this. And we're going up with our cumulative measure of the S&P 500 based on price as well as volume. And you can see we're ticking up with price. We're showing a little bit more strength. We're actually breaking out a bit here based on volume, and that could be positive. We're bouncing up off of the moving averages with our advanced decline line studies with NYSE common stock, the S&P mid caps, and small caps. We saw a little bit of an improvement after Thursday. We saw more of a continuation on Friday. Here's our daily chart, and I've scrunched it down to 2 years instead of the usual 3. We didn't quite get down to and it's hard to see with this big P in here. And we do have a pivot point, and we were able to bounce up off of that. We've maintained the 50-day moving average. I drew a trend line on here. We didn't quite get down to that, but we were seeing a lot of these support areas coming together. And for at least right now, that support has held. And you can see the massive spike. It's like it was options expiration, but it wasn't. We just saw a really big increase in volume. We're bouncing back up and turning more positive with our short-term stochastic. Intermediate term, we're still declining and looking more negative. We're rolling over and still extreme positive in the long short term. This is a further subdivision of the short-term time frame. That's why I say short term, intermediate short term, and long short term. Looking at our 20-period double and triple exponential moving average study, yeah, we're showing some improvement, but we weren't able to recapture these. It's the other moving averages that we got back above. So we want to see this continue to go up to look more positive. We went up with the 20 and 50, which we also did after Thursday, even after declining, and now we're turning up with the 200. The force index had been negative, is now switched back over to positive. These are the other moving averages. And I said it looked like we broke below this, and that was actually turning things negative. And we did. We closed below both of these lines, but maybe it was enough of a support level to actually give us a little bit of a bounce with the 20-period moving averages. We're back above the midpoint with our standard deviations chart. So that's turning more positive. The balance of powers just barely. It's like 0, but it had been negative. So it's showing an improvement there. We're still looking a little bit more negative with the go, no-go system with the lighter shade of blue bars. We did get back above the midpoint with our highest high value. We came all the way down intraday to the lowest low value and then bounced up off of that. PTM squeeze is continuing to decline. It's no longer extreme positive, so this is still negative. Even though it's showing blue, it's showing the darker blue. And we're coming right back up to the underside of our 50-period double and triple exponential moving averages. We would like to be able to break back above this. These areas were providing support as we were chopping sideways. We broke below that. It would be a lot more healthy if we could get back above this. And here's the 50-period moving average. We didn't quite get down to it. I was watching for that, but we didn't. We bounced at a more round number rather than actually hitting a moving average. And equivolume is still, equivolume is the chart on top. Ease of movement is still declining, but above zero. We're still flat with the Arun and still positive there. We did see a nice little bounce with the S&P McClellan oscillator, but we're still below zero. So when we look at the summation index, we're flattening out, but we're still declining based on price as well as volume. We need to see follow through. We're also showing an improvement with the NYSE McClellan oscillator, but we're still below zero. So the summation index for the NYSE is still declining based on price and volume. This is encouraging. We saw a bit of an uptick on a down day after Thursday. We're seeing a little bit more follow through with the Swenlin trading oscillator. It will not turn positive until we cross back above zero, both based on price and volume, but it is showing an improvement. We're rolling over with the PMOs. Our oscillators take longer to turn, and they're actually looking more negative. We've already changed over to negative based on price and volume. We're seeing a bit of an improvement here with the PMOs that are rising after getting barely extreme negative. We're barely ticking back up with the buy signals and the buy signals, and we're starting to flatten out with the PMOs that are above zero. So we're seeing some slight improvements here. We've switched from being negative over to neutral for the Elder's Impulse system, but the parabolic SAR is still negative. We're going to have to clear some of these previous highs for these dots to come back underneath. The slope oscillator is no longer extreme positive, but it's below its moving average and continues to decline. The MACD is crossing below its moving average. So on a momentum basis, we haven't switched back to positive yet. We're still looking more negative in the short term. The intermediate term oscillators are negative, and we're still rolling over with our longer term oscillators. We were able to get back above the 20-period moving average after almost getting down to the 50. The bullish percent index, it picked up a lot of the initial weakness earlier in the day, and it's continuing to fall. We want to see this turn and go back up. It's still positive, but it's declining. And the NYSE bullish percent index also really didn't show an awful lot of an improvement there, but we're still positive with this. We're still looking negative with the NASDAQ 100 bullish percent index. We are below 50 and declining. The money flow ticked up and is still above 50, so that's looking more positive. After being negative with the ultimate oscillator, we now crossed back above 50, and we're right on top of each other. The green line and the red line, they're giving the same reading right now. Could that be a little bit more indecisive? We don't know if it's going to turn back and look positive or actually switch over and look negative with the vortex. We did turn up and we're still above 50 with our 14-day RSI. We crossed back above 50 with our 9-period RSI. With the up day, on balance volume did increase and we're above the advancing moving average. We're just slightly below 50 when we look at our 20-period moving averages. It would be better if we could get above this. And here's the study that we've been looking at. We had an extreme negative reading and then followed by a very quick extreme positive reading. And then we saw a nice little run up after that. We don't know if there's going to be more to this or not. If we can see this continue to go up and then followed by price going up, of course, that would be more positive. We're kind of comparing it to what happened back in March of 2023. We saw a kind of similar thing where we went down and actually were looking more negative, but then saw some improvement after that. Stocks above their 50-day moving averages in the S&P, just barely above 50 again. It had dropped to negative. Now it's leaning a little bit more positive. We're advancing with stocks above their 100-day moving average and going up with the 200-period moving average steady. The copy curve is still negative. It's a momentum oscillator. And we ticked up, but we're not extreme with the Sean trend meter. We're coming up to the upper side of this mini rainbow. we had been right inside of it. And it looked like earlier in the day, okay, we're falling below the rainbow. And now we were able to close back above it. So Dorothy must really be confused. Somewhere under or over the rainbow. Looking at our trend, though, the Heiken Ashi is still picking up that things are looking more negative, where we're still positive with the Kagi chart, but we continue to point down. The Renko thinks that nothing ever went wrong, and the three-line break is also thinking, what? Sell-off? What? I didn't see anything. All right, and we're coming back up with our 150, and I should have put this on the list. We're just barely extreme positive with the 200 period moving average study. We don't know if we're coming up to a new 50-day cycle. I don't use this to make decisions. This is more informational, but the date can change as we get closer. I have to go in and eyeball it and see what date it's actually telling me. Here's the Hindenburg-Ullman where we did see the first trigger, but we're still waiting to see if there's going to be a second trigger. Now, the one drawback to this is that there's a one-day lag with this indicator. We don't get all the information about Friday until after Monday. So it could, in fact, have actually spiked up again, because usually this sees an up move and a down move. That's what it's freaking out about. We don't know if it was strong enough in Friday's session to actually trigger a confirmation signal. We're positive across the board now with the Keller market model. And we're still negative with the bonds based on price. We're negative with commodities and the short-term trend of the dollar. And look at this. They actually came in and made a little change here. We're actually turning back negative with the PMOs. And that's what we're seeing on our chart too. I like it when this chart lines up with the charts that we look at, and they were out of whack there for a while. Saw lots of red. And a lot of this ended up happening earlier on in the day. And then everything turned positive, and we were just bouncing. We didn't really, we were just repairing the damage that was done earlier in the day. Then the last thing to trigger was that the dollar crossed below 105, which really is positive for stocks because the dollar was declining. And we had all the sectors, which I don't know what they were earlier in the day. Things were just not looking good. But by the time we closed, all 11 sectors were positive, with energy being in the lead. We did have tech, and a lot of the things that happened with the NASDAQ and NASDAQ 100, you might look at the closing value from Thursday to Friday and go, it was a pretty boring day because it was virtually unchanged. But to be down as much as we were down and then to come all the way back is what we're looking more positive at right now. Equal weight did show some improvement here, so we're coming down with the ratio as the broader market actually did a bit better than the big mega caps. The Dow was able to bounce back up and get above this pivot point, but we're still below the 50-day moving average. The diamonds, after being decidedly negative, have now switched back over to neutral, so that's showing some improvement. We came down almost to this pivot point for the NASDAQ. Maybe that's providing support. We never got down to the 50-day moving average. And kind of that same thing here with the NASDAQ 100, just coming down to this pivot point, never got to the 50-day moving average. We still are negative, though, even though this bar looks very interesting. To open at the high, go all the way down, and then to close just about at the open. That could be a pretty positive chart just by looking at the bars themselves. The momentum, we're just on top of the moving average right now. We don't know if this is going to cross over negative for the NASDAQ 100 or actually be able to turn back positive. And we got back above the 20-period moving average with the QQQs. We lost that earlier in the day, and then we were able to get that back. And you see here the Qs were unchanged on the day, which you might go, well, nothing really happened. Well, look at what happened. The small caps were up over 1% and just coming a little bit higher into the range they've been in. They've switched over to positive with the Elder's Impulse system for the small caps. When looking at the Russell 2000 small caps, we're crossing just barely back above 50 with the RSI. We still were able to get back above the 50-day moving average. We're negative, but starting to turn up with the momentum for the small caps. The mid caps, we were kind of watching this as a potential area of support. We never got down to this pivot point, and they rebounded and got back above the pivot point and back above their 50-day moving average. And the mid caps have now turned over to positive with a green bar where they had been negative with red bars. Apple was up a little over 0.5%. And the longer we stay above both of these lines, the more we might see a golden cross here. Tesla was down and still kind of battling around its 50-day moving average. Saw a little bit more profit taking in Nvidia, but still probably the strongest stock there is right now. Microsoft, after coming down and falling below its 50-day moving average, and actually was quite negative, it came back to close up almost 0.25% right at its 50-day moving average. Meta was barely unchanged, but it was pretty weak earlier in the day and came back and repaired a lot of the damage. Same thing with Amazon, although it closed more in the middle part of its bar, it still ended up being down 1.6%. Google ended up being up after coming down, hitting its low, and then bouncing back up as well. Netflix was down 0.87%, but is still above its 50-day moving average. The FANG index closed well off of its lows, didn't get back to the highs, but showed a lot of improvement. The financial sector has been able to get back above its 50-day moving average. The staples to tech ratio, this is starting to go back up because even though tech recovered, staples were still up more. So that's why we're seeing this ratio going back up. The dollar ended up declining, but it's still in a longer term uptrend. The correlation between US and world stocks shows that the shorter term correlation is getting a little stronger, and we're pretty much staying fairly strong with the longer term correlation. We came down to the 50-day moving average and bounced up. Staples are up 1.57%. Utilities also bounced up 1.73% after seeing some recent profit taking. Healthcare was able to get back above its 50-day moving average. The energy sector was also up over 2.5%, still not back above its 50-day moving average, at least yet. And we were up 0.75% with the total stock ETF. We bounced up off of the 50-day moving average, mostly. We were down with the 10-year yield. We were up with the 10-year with price. And we're coming down a little bit with the Qs because the S&P was up where the NASDAQ was unchanged. So we're seeing this ratio coming back down. Saw a little bit of an improvement, but we're still below a declining moving average when we look at discretionary to the S&P. And after breaking out, when we compare large cap growth to large cap value, we're coming back down to the moving average. It was really value that helped lead the bounce in Friday's session. So we're coming back down to the moving average with the large caps, dropping down more with the mid caps and the small caps. So this isn't confirming the positive things that we're seeing, at least yet. We're still looking a little more negative with our 10-day average of the S&P 500 highs minus the lows. We showed some improvement here with our 19-day advanced decline ratio. We climbed back above zero based on price and volume. And we're not really moving. We're actually still declining here with the S&P to utilities ratio. We want to see this going up. It still continues to go down. So that's a warning sign. And we're coming back up here with the staples to S&P 500 ratio. We want to see this coming down. So what's our outlook for Monday? We're still positive when you take everything together. And we're losing this positive edge to a little bit as this weakness is continuing to develop. But we did see a really nice bounce. And I should have changed this. It'll be changed later on, but I'm not going to record the whole video. We're going to get the S&P Global U.S. Manufacturing, the final reading on Monday. This is a big one. The ISM manufacturing and construction spending, not as big of a deal, and all the crazy stuff going on. Here is the calendar for the upcoming week, where ISM is on Monday. That's a biggie. And then we're going to get non-manufacturing, which you could call services. That'll be on Wednesday. And then on Friday, we're getting our friendly old employment situation report. And here's looking at the whole week. And I try to block off whatever day that applies to. We're pretty positive seasonally, but we've really been deviating from normal seasonal patterns that we've been seeing. The Dow and the S&P are just flat out positive, where the NASDAQ is neutral to positive. Monday is the strongest day of the week. We got that going for us, and it'll be the first trading day of the month. So there might be some inflows of money coming in as well. Now we're looking at June, that May has finished. We do see some positive seasonality for the first few trading days anyway, up until about the 10th of June or so. And I'm waiting to get updated versions of these charts because we're through May now. But according to the Stock Traders Almanac, if you take out 2020 and don't count that, it's like, yeah, don't count whatever doesn't fit your scenario. But this does see positive seasonality. They just think 2020 was an anomaly when it was actually something that really happened. We do have a good track record when it comes to election years for the S&P, and now this will be the last time I show this. I'm switching it over to the weekly chart. I'm also going to send this one over to the weekly chart, weekly video, where we have historically seen June, July, and August looking pretty good during the fourth year of a presidential cycle. I don't have the updated chart for this. Well, at least one day, the 31st, ended up being pretty positive, according to this research. So the warning signs, and this is where I spent most of my time updating, so I hope I didn't make as many mistakes here. We did set that all-time high with the utilities and staples being strong, and that's been a warning sign to us, and that's still kind of on the table. We're also keeping an eye on energy to see if it turns more defensive, and healthcare is also another defensive area. Growth to value and discretionary to staples, they didn't really improve all that much because it was value that saw a lot of the bounce in Friday's session. The S&P and NYC McClellan oscillators, they're still negative, but they are bouncing. Our oscillators for the S&P 500, they are still turning negative. They are slower, so it takes longer for them to actually realize what's going on. The Swenlin trading oscillator is negative but bouncing, and this can be encouraging at least to this point. The parabolic SAR, that is still negative though, and the Copic curve is negative, and the 20-period moving average study is negative for the S&P, but it is bouncing. The equity put-call ratio, I'm just going to assume that it's still going up. And the summation index, both for summation indexes or indices, if you want to say it the right way, they're declining for the S&P as well as the NYSE. And then the bullish percent index for the NASDAQ 100. That's a bit of a concern. We want to see that going up. But like I said, the NASDAQ and NASDAQ 100, after being down pretty fierce, ended up being unchanged on the day, pretty much. Positive signs, the advanced decline lines that we follow, yeah, we came down to the moving averages, but for right now, we're bouncing up off of those moving averages. Our positive indicators are that we're still above 50 with the bullish percent index for the S&P, but we are still declining. Chaikin money flow, this looked good after Thursday, even with the down day. It's still looking good even after Friday, as well as the Chaikin oscillator, the money flow, ultimate oscillator, which was on our negative list yesterday. Now it's back on our positive list. And the vortex, it's right there. They're even. The green line, and I should have put the green line even with the red line. So I did make a mistake here, but they're right on top of each other, at least as of right now. And the momentum for the NASDAQ 100, it's in danger of crossing over negative. It's right on top of its moving average. The financial sector is still looking pretty good for right now. So our conclusion, we are still positive. There is that weakness that's developing, but we had a bounce up from the 50-period moving average, which was at about 5,200, and that's showing some improvements based on what we're seeing. And we do have positive seasonality. In the short term, we turned back to positive because we had gone negative after we lost the 20-period moving averages. Now we regained them, but we still want to respect this weakness that we're seeing. But at the same time, there is positive seasonality. It's a little less determined yet with the intermediate term. We're still positive there because we bounced up off the 50-day moving average, but there's still this more intermediate term weakness that we're seeing. So is it showing signs of improvement? And we're still positive in the long term since we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a very good weekend, and I will talk to you in the next video.